Good morning to everyone. Jay Del Rio welcomes you for today's webinar, 2022 Tax Reform Proposal Analysis. It's my pleasure to introduce to my colleagues and speakers for today's webinar. We have Maria Jose, who is our Transfer Pricing Director in the Mexico City office. We also have Renata Aguilar, who is our Tax Director in Tijuana office. As well, we have Leonardo Gámez, Tax Partner of Monterrey office, and Arnoldo Rodriguez, Tax Director, also from Monterrey office. And finally, myself, Victor Ramos, Tax Partner of the Mexico City office. So for today's webinar, we have the following agenda. We're going to discuss the main proposals that have been submitted to the Congress regarding the federal revenue law, the income tax law, the value-added tax law, and also the federal tax code. Finally, we're going to end with a Q&A session. So we invite you to send your comments or questions you may have during these 2 hours through our chat, please. So as an introduction and background, on September 8th, the executive submitted to the Congress through the Ministry of Finance and Public Credit a proposal, or what is called the economic package for fiscal year 2022, which includes some proposals and amendments to the main federal tax law, which includes the federal fiscal code, the income tax law, and the value-added tax, as well as the special tax on production and service law. The main objectives of this document, as stated by the executive, are to include certain methodologies to reduce the administrative simplification, as well the reinforcement of legal certainty to achieve a more efficient and equitable tax system by adding some specifications to certain articles on law. So what does this proposal intend? First of all, as I mentioned, is to avoid and fight elusion and tax evasion. Also, by including some new regimes, basically on individuals, the tax government is seeking to increase the base of taxpayers for those who are doing business, what we call the informal sector, in order to increase the tax collection. Also, as we know, we have been impacted by this pandemic. So there are some proposals that seeks to have an economic reactivation. Finally, what this proposal includes or also seeks, it's a greater control and adaptation to current regulation that aim to increase the taxable base of taxpayers. This is consistent from the previous tax proposal and is what is being told by the current administration, and the premises of this document continues with no increasing or not creating new taxes for collection. Also, they are seeking to combat corruption and impunity, as well as simplified tax compliance for taxpayers based on technology and other tools that have been put on facilities to the taxpayers. So as a summary, we can say that the 2022 economic package seeks to facilitate the taxpayer procedures and self-determination. Please consider that here in Mexico, we have electronic accounting, we have also electronic invoicing. So basically, tax calculation have been done on a better way and have achieved this simplification that I have already mentioned. Also, this new economic package is incorporating simplified regimes We're going to talk about this in some minutes, but basically there's a new regime regarding individuals that seeks to incorporate or to increase the basis of the taxpayers. Also, a premise that is mentioned by the executive and the current administration is that these proposals are based on citizens' trust, and we're going to discuss what does this mean. Also, there's some data that have been recently published by the Mexican tax authorities that states that the collection have been increased in a significant manner, even though there has not been an economic growth in Mexico. So this is based basically for a better audit process from a tax perspective. And actually, there are certain rules and certain modifications that have been proposed in order to have a better audit process than the one we already have. So, well, we will start with the modifications of the revenue law. This law is quite interesting because actually it's a law that is fully modified on an annual basis. This law basically states what the Mexican tax authorities expect to collect from all federal taxes. And this expectation is based on macroeconomic factors. So can we go to the next slide? So we can see which are those economic factors that the Mexican government is expecting. First of all, they are expecting an annual inflation of 3.4%. This is lower than the one we expect to have at the closing year of 2021. Actually, it is expected that this year we're going to close around 6%. So also there's a GDP growth of 4.1%. And also there's an expected increase on the interest rate of 5%. Before the pandemic, we used here in Mexico to have an interest preference rate that was around 3%. Now the bank, the national bank, has been increasing in 0.25 basis in the last two meetings that they have held. So I think this is consistent on what we are seeing on the rest of the world, as well as in the States. Also, we're expecting an exchange rate of 20.3 pesos per dollar, which we expect to not to have a lot of fluctuation on the FX currency. And as you may know, Mexico is also dependent on the oil and gas industry. So we expect a decrease of the barrel price of 55.1. I know that in the recent days, barrel prices have been reached maximum, historical maximum. So probably this should be modified, or at least I don't know how realistic this might be for the next year. This is what I mentioned before, and it's quite interesting, this slide, at least for me. There's an expectation on the total estimate of the Mexican tax authorities at collection. Basically, the Mexican IRS is expecting to increase in more than 12% the collection on taxes, based on that there are no additional taxes or there are no rate increase. This confirms what I just said, that audit process are becoming harder, are becoming more recurrent, and we all need to be prepared on how we deal with this relationship with the Mexican tax authorities. Continue with the main tax indicators. There are no changes on surcharges regarding late payments or extensions based on not timely filed taxes. Also, here in Mexico, there's a tax withholding when you invest on the financial system, and this withholding is calculated on the capital and not on the interest. So there's a decrease on this rate on withholding, and basically the reason of the decrease is the high inflation we're dealing with. Also, there's a tax benefit that is maintained through the revenue law, which basically states that taxpayers may be entitled to have a tax benefit of a reduction of 40% regarding fines of tax omission. So this is maintained too. The next slide also it's quite interesting because, as I mentioned at the beginning of my exposition, the revenue law, it's important, or it has two main aspects. The first one is the expectation on collection on the federal taxes, and also in this law we have some incentives regarding federal taxes. So there are three main incentives that actually are maintained, and those are related to some creditable income tax regarding the use of diesel and biodiesel, as well as expenses done for the use of tolls on the Mexican highway network. So the message here is that the tax incentives that were included in the 2021 revenue law are maintained. There are no major changes on this. And the next slide, please, is quite interesting because this is the comparison on what is the Mexican tax government expected to collect. As we may see, the income tax is expected to be increased in almost 9%. Also, VAT it's expected to increase 24%. And the reason of this is because indirect taxes based on the increase on consumption and economic growth, it's quite normal to have this growth. There's a tax that probably does not represent a full percentage or do not represent a high percentage on the full collection. But if we compare it to the previous year, which is the fourth tax design, which represent 61%, this tax is related to the automotive industry. So as you may know, there are certain sectors or industries that have a lot of impact within the COVID. So Mexican government is expecting to have a recovery on this industry. Well, thanks. So now we're going to talk about the major changes on the income tax law. The first change relates, if we can go to the next slide, please. It's a clarification that is included on Article 8 of the Mexican income tax law. Basically, this new addition refers that whenever the taxpayers calculate their foreign exchange gain and loss, they should consider the exchange rate established by the Bank of Mexico. Basically, the major change includes that these exchange rates should be considered also for exchange gains, because on the previous law or in the on the current law we have, it only refers for the tax laws or the exchange laws. So it's just a clarification that they want to seek a symmetry also for the gain. This is something that has generated a lot of discussion. Basically, there's an addition on Article 9 in which the proposal intends to clarify which should be the order or how you should credit the income tax. Please bear in mind that here in Mexico, it's possible to credit against the annual income tax, the income tax that has been paid in foreign countries. Also, during the year, taxpayers are obliged to make advance payments in order or as a reference for the annual tax. So basically, what these new regulations 1226 or establishes, is that the order that should be credited, first of all, you should credit the advance payment and then the income that should be paid abroad. This is quite relevant because the purpose of this addition is to stop some refunds that taxpayers may have. So this certainly will impact the cash flow on companies. Also, this is quite important because this is something that we are going to mention in a constant matter. This is related to back-to-back loans. Here in Mexico, we have a broad definition of back-to-back loans. Basically, the addition is that if there's a finance transaction between related parties and this financial transaction lacks of business reason, this should be also treated as back-to-back credits. This is important because if it is if this transaction lacks of business reason, this should be treated as a dividend payment, which may arise on different tax consequences. So the question here, and probably this is something we're going to discuss on the next slide, is which are the business reasons? And that's something tax advisors has been discussing for the last weeks. Also, a major change that has been proposed on Article 14 refers to the reduction on the monthly installments. As I mentioned, on a monthly manner, you are entitled to do advance payments in regard to the annual income tax. There's an option on law that when you expect to have a lower profit at the end of the year, you can ask for an approval to the tax authorities in order to reduce these monthly installments. So there's just a clarification on the methodology on how taxpayers should calculate this reduction, and they need to comply on certain requirements. So from now on, I think, Leonardo, please go ahead, and thanks all for hearing.
Thank you, Victor, for that kind explanation. First of all, again, thank you for joining us in this webinar session. It's a pleasure to have you here. So moving on with the following changes related to the income tax law for the reform in 2022, we see a clarification from the government in a particular type of transactions that for a legal and a tax standpoint of view in Mexico, you could split a value of the asset in two main concepts. One would be the ownership and the other one would be the usufruct, which would be pretty much the right to enjoy the benefits that could generate that asset. So the clarification that the government is making in here consists in three main items. The first one relates to the revenue recognition, the second one relates to the cost attribution, and the third one relates to the value of that operation will have. So nowadays, unfortunately, the government has detected that when this type of transactions occurs, some taxpayers have been taking into consideration some abusive tax practices or incorrect tax practices from the point of view of the authorities. So the modification here, it's just a clarification from the tax standpoint of view of what will be the correct treatment. So in this case, particularly for the value of the operation, the value that the government looks to be considered as a taxable revenue would be the value that appears on the appraisal, which most of the cases, these appraisals are made by the transfer pricing department, where they can determine what will be the value of the operations, even though it has already been split throughout the ownership or the usufruct. In this case, the value of the appraisal will be the value that will be considered taxable for tax purposes. That's the clarification that they're making. The other element that they're clarifying as well, it's the time in which the revenue should be recognized, which in this case, they said that it will not be at the expiration of the agreement or of the usufruct, which could be later down the road in 5 years or 10 years in the future. But what the government is saying in here is that the taxable revenue will be triggered at the moment when the operation takes place, no later down the road in the future. So that's a second clarification. And the third one relates to the cost. Usually when you plan to split the cost, you would have one company that holds the ownership and another company that would hold the usufruct or the benefits of that. What happened is that in the practice, some companies were not attributing the proportional part of the cost for each of the parts. So what the government is implementing here in the reform, it's just a clarification that whenever you're carrying out these type of transactions, you also need to attribute the corresponding proportion of the cost per each of the items. So if you are going to split your asset in 70-30%, 60-40%, any proportion, you need to attribute the cost in the same methodology. So how is the government going to make sure that taxpayers follow these rules? They're going to obligate the notary publics to file an informative where they will need to disclose information about these type of transactions. And this is a modification because in the past, the notary public was the person who would help you to prepare all the legal minutes, all the legal agreements where you could state the name of the parties involved, the date in the transaction took place, the value of the asset, and how it was split between the ownership and the usufruct, etc. But that was pretty much it. You would only need it to have it as support documentation in case the government comes in and do an audit. In this case, the modification is contemplating that the notary public will need to submit upfront this information 30 days after the operation takes place. So what we can read between the lines in here is that the government wants to have a lot of certainty and clarity about taxpayers who are carrying out these type of transactions, because from their point of view, they just want to make sure that these transactions follow the rules that they're suggesting here and are avoiding to implement incorrect tax practices. So moving on with the other modifications that we can see in the income tax law for 2022 has to do with corporate restructurings and a wording or a phrase, a concept that we have been hearing in the past couple of years, and we will still be hearing of it in the future, which is the business risk. In here, as you know, whenever a shareholder wants to sell shares for a Mexican entity in Mexico, some capital gains might need to be attributed, and therefore an income tax might need to be triggered because of that sale of shares. However, there is the possibility that companies set up in Mexico ask for an authorization from the government to carry out a corporate restructure, which if the government authorizes you to do so, the main benefit of having it is that you will calculate the tax related to the sale of the shares. However, you will not make the actual disbursement or payment of that tax, but until the time the shares leave the group, if that even happens. So that this means that if you remain the shares within the group, then the tax related to that business restructure will not even be paid at all. So the modification that we see for 2022, it's first of all, they're just clarifying that this benefit will be granted to Mexican residence companies. In the past, it used to set to companies constituted or set up in Mexico, but now they're changing a wording in one of the paragraphs where they state that this authorization can be granted to Mexican residence companies that belongs to the same group. And the second change, which is the most important one, refers to a lack of business reasons. As we have been mentioning in the past, this concept of business reason, it's very important for the government. Actually, it is so important that a couple of years ago, they even incorporated in the federal tax code a provision or an article specifying that in case they come and make a reviewing in an X type of transaction, if they found that the transaction lacks of a business reason other than obtaining a tax benefit, they could reject the operation and give the proper treatment of the operation as if you had not taken up as you had planned. So in this case, what they're saying here is that in corporate restructures, if at some point in time, tax authorities go and make an audit on you and determine from my point of view that your restructure lacks of a business reason other than obtaining a tax benefit, I could reject you the authorization I had given you back then, which means that at that point in time, the income tax that you had calculated but you had not paid at that moment, you will need to be paid because it will be triggered at that point in time. So definitely a very important point to keep in mind to make sure that you have your file and be able to demonstrate that an internal restructuring within your companies really has a business reason other than obtaining only a tax benefit here. So in essence, what the government wants to avoid is that you carry out business transactions just to avoid taxes. That's pretty much the summary of it. So another of the modifications they incorporated in this same topic of the business reason in corporate restructures, can we go to the next slide, please? It's some of the requirements that nowadays has the auditor's opinion that needs to occur in these type of transactions. Part of the requirements for the government to grant you this tax authorization is that you need to have a CPA issuing an auditor's report that should include various information. They added a few requirements to the CPA's report. Some of the requirements are the value of the book's value of the shares, the organizational chart of the group, where the percentage of ownership or the partner shareholder is observed, and this is very relevant, directly or indirectly. So, because in here, it does not precise or mentions how high you need to go in the chain of companies within your organization. So from what we can see in here is that they also want to see the business segment, the line of business for each of the companies, etc. So it's clear to see here that the government wants to have clear visibility about your whole group, so before they can approve you this reorganization. Also, it will be important to report all relevant transactions prior 5 years to the restructuring, and 5 years later down the road, if there are certain transactions that are considerable as relevant, which the article specifies what transactions are considered as this, then those needs to be reported as well. We can see some additional requirements that were added to certain type of deductions that are trying to increase the actions that we need to take for deduction purposes. So there are 3 elements or 3 types of transactions that we can see in the slides. The first one relates pretty much to purchase of gasoline and gasoline for vehicles. The second one relates to disbursement for technical assistance, technology transfer, or royalties, and the third one for bad debts accounts. So just very high-level explanation of each one of them. Nowadays, part of the requirements for companies to be able to deduct gasoline payments, it's First of all, they need to be paid throughout a bank institution, whether if it is a credit card, a debit card, a wire transfer, etc. As long as it is not paid in cash, it's a bank institution. And secondly, you need to make sure that you receive an invoice or an electronic invoice for the expenses related to gasoline. So unfortunately, nowadays, a few gas stations has been purchasing gasoline directly from the organized crime rather than from the Mexican oil company. So if the government detects that some gas stations are doing these illegal practices, they can lose their permits. Therefore, they will not be able to sell gasoline later on. So the requirement in here for companies who wants to deduct gasoline expenses is that you need to make sure that the invoice that you receive from your supplier has the permit number, and that you review that that permit number is valid at the moment when you receive it. Which, frankly speaking, I find it a little bit complicated, that you may fall into an assumption where you will not be able to deduct these expenses, because say, for example, that a gas station is carrying out these illegal practices and the government finds out, besides revoking their permit, it's likely that they will close the business. So it will be complicated for you to receive a gasoline service from a gas station that does not have its permit valid. But anyway, it's something that we need to take into consideration in case we want to be able to deduct gasoline expenses. The other topic to consider is, can we go back please? It's related to technical assistance, technology transfer, and royalties. Nowadays, the current disposition mentions that if you want to deduct this type of expenses, you need to make sure that your supplier has the necessary technical knowledge to be able to provide you this service, and that it needs to be provided directly by the service provider. However, they allow the possibility that this technical assistance or royalties are provided throughout a third party and not directly by you. The modification that it's contemplated in here is that if this is the case where you provide technical assistance services throughout a third party, the modification says that this third party first needs to be a Mexican resident, and secondly, that there needs to have an agreement or a contract related to the specialization services, which, if you have heard this word of specialized services, it might ring a bell to you to the recent reform from a labor standpoint of view that prohibit the subcontracting scheme and only allows subcontracting schemes when you're talking about a specialized services companies. So in this case, they're trying to connect or to sync the modifications in the income tax law with the recent reform for labor purposes, where if you're planning to carry out technical assistance or royalty services throughout the third-party suppliers, they need to follow under the same book of rules for a specialized services company. And the third modifications as well related to additional deductions would be for bad debts accounts. Nowadays, for income tax purposes, companies are meant to consider as taxable revenues depending on when the invoice is issued or when the service is rendered, or if you already provide the goods in advance. So for those taxable revenues, you will be paying upfront the income tax in Mexico. However, if at some point in time you find out that you will not be able to collect that debt, it is possible for you to deduct in your annual tax return as a matter of neutralizing the effect, the amount of those bad debts. So in this case, nowadays we have kind of like two categories of bad debts, and each category has its own requirements for deductibility purposes, where one basket would be for debts lower than 30,000 UDs, which would be something around 150,000 peso. If you fall under that category, there are certain requirements that you need to meet so you can take those deductions. But if your debt is higher than this amount, then you need to comply with additional requirements, which the ending or the final step under that basket was that you needed to exhaust all the legal means to obtain the collection which in other words, this means that you need to start a legal procedure or a lawsuit where you file the lawsuit against your debtor, and that was it as of right now. The modification that it's contemplated is that now this lawsuit will not be enough, but you will need to have the final resolution from the competent authority where they state you're right, it's impossible to be able to collect that debt. And at that moment in time, it's when you will be able to deduct in your tax return those bad debt that you have already considered the taxable revenue. So that is one of the changes related to additional items to keep in mind for deductions. If we move on to the following tab, we find some modifications related to ThinkUp rules. As you may know, Mexico has certain ThinkUp rules, which in summary says that interests that are generated for debts with related parties abroad could be, part of them could be non-deductible if the debts with related parties abroad exceed 3 times the equity of the company. And there is a specific procedures on how you can determine the equity, that amount of 3 times the equity of the company. One way would be throughout the equity itself, according to accounting books, and the other way would be based on tax attributes or tax elements, where you can take into consideration the equity tax account, the net profit account, which in the slide you can find them as QCAC, which are tax accounts for the equity and the net profits. So nowadays the disposition mentions that the way you can determine your equity would be if you sum the 3 items, but the modification that they're contemplating here is that you will need to reduce the tax losses that are pending to amortize. This means, or this could represent that the limit that you have been having for the past couple of years could be decreased substantially if you have tax losses pending to credit. So definitely a red line to keep in mind for companies that are close to the border limit of ThinkUp rules. We strongly recommend to start running a couple of a scenario on what would be your position if this reform is approved, because it could put you in a position where part of your interest could be considered as non-deductible. And this limited or this procedure where you can take the tax attributes will be limited to use if from that calculation it turns out to be 20% more than the actual equity of the company. And in case of, or it will be applicable in case of an audit review, you are able to demonstrate with support documentation and that there is a business reason why you have those numbers and you're using that methodology rather than directly the equity part. There are some exclusions as well for ThinkUp's rules. Strategic areas needs to have authorization from the corresponding authorities, and also non-regulated financial institutions will be excluded as well for applying the ThinkUp rules as well for this question. Moving on to the other modifications that we can find in the income tax law for corporations relates to fixed assets and investments. If we can move on to the next slide, please. What we find as part of the modifications, it's the definition or the concept of the investment. So we have a few items that are being added to the concept of investment. These items are expenses for the preparation of the physical site, installation, assembly, handling, delivery, and as well those related to service contracted for the investment to work. So in summary, what the government tries to clarify here is that these items will be considered as capitalized or as part of your fixed assets and should not be deducted in 1 year or in the year in which they were incurred as if it was an expense. They already detected that most of these items had been in the past being deducted throughout an expense rather than throughout a fixed asset. So the disposition just comes to clarify the position that the tax authority wants you to take care related to fixed assets. That one of the new modifications as well is to file a notice when disposal of an asset that it's no longer useful for the business purposes. Nowadays, when you have an asset that it's no longer useful to carry out any business transaction, you can proceed to write it off from your books and automatically take the full deduction of the pending amount that was of the value that was pending to depreciate. Nowadays, it was just as long as you do it in your accounting books and you consider in your tax return, that was it. However, what the government noticed is that some taxpayers were using abusive or incorrect practices where they took this accelerated deduction by saying, hey, this asset, it's not useful for me anymore. But later down the road, 1 or 2 more years in the future, they decided to resurrect the asset and then take the pending depreciation that they left back then. So they were hitting twice the depreciation of that asset. And the government says, hey, you know what? I already noticed this, and I'm going to allow you to make this disposal of assets that are not longer useful as long as you file a notice for me. If you do not file this notice, and I'm going to audit you, I will reject this type of transactions. So again, what the government wants to make sure is that avoid these abusive or practices or undue deductions by having a better control when you file a notice of this. Moving on to the next slide, we can find some elements related or additional clarification about fixed assets as well. We were talking a little bit earlier about the usufruct. Just a clarification in here that in this type of transactions, this item, it's not an expense that you can deduct in 1 year or in full, but it will be considered a fixed asset, which will have a maximum deduction rate for depreciation worth of 5%. In case of intangible assets, the amortization of intangible assets for exploration or exploitation of public domain assets, they're just clarifying that these intangible assets, again, they want you to treat them as deferred expenses, not hitting them directly in 1 full year with the full deduction. And related to investment in the mining sector, they're establishing that the fixed assets for the facility addition, repairs, improvements, etc., everything related to the investment in the mining area will be subject to a depreciation rate worth of 5%. Moving on to the following slide, we have tax losses in case of a spin-off of companies. If this is our case, the government just clarifies that the tax losses pending to amortize in case of a spin-off, they will need to be distributed in the proportion in which the inventories and the accounts receivable or fixed assets are separated. So it's just a clarification that that would be the way to attribute the tax losses to the companies resulting out of that spin-off. And they're mentioning a few cases in which it will be considered that there is a change of shareholders, and if this occurs, the application of the tax losses within the spin-off could be limited, which means that you will not be able to use it if you fall under these categories, where you change the shareholders in more than 51% of the shares with the right to vote directly or indirectly. And if there is a suspension clause for change of shareholders, the moment will be at the signing of the contract. This suspension clause, just to give you an example, could be a clause that you could set up in your agreement where you can say, so say for example that the spin-off takes place in October 1st, but you add a clause that says the spin-off will take effect once all the inventory accounts are paid, which could be 6 months in the future. So what the government is clarifying here in the modification of the law says, regardless of the fact that you have a suspension clause that could lead you 6 months in the future, from my point of view, the spin-off will be triggered at the moment when the act takes place or when the operation takes place. So moving on with some of the topics related to transfer pricing, my colleague Maria Jose will be explaining about this part.
Thank you, Leo. Next slide, please. Hello, everyone. Thank you for joining us today to this webinar. Well, regarding transfer pricing, the major changes proposed are related to the obligation to document your intercompany transactions with domestic related parties. In the same way that it is established with foreign related parties. That means in the past, the wording of the law, it was a little blurry for domestic related parties. It said only to be to support that your transactions were at arm's length, but not necessarily explain in detail what kind of documentation did you have to have. Now, these domestic transactions were added to Article 76, Section 9, and obligates also these groups or national groups to elaborate transfer pricing documentation. Some concepts are also changed, are detailed. The law in the past discussed prices and considerations when they were explaining these comparisons between related parties and third parties. Now includes in the wording the profit margins. I believe in the practice we all were comparing and were using for transfer pricing this profit margin, but now are in the law. And this wording is now in all articles that refer to transfer pricing, 36, 179, and others. Another important change is that the taxpayers was, and this I think is going to affect the multinational groups. In the past, you were obligated to document the functions, assets, and risks of the taxpayer. Now, what is proposed is that you also have to explain and document the functions, assets, and risks of the foreign entity, the related party involved in the transaction. So, what that means is we have to improve our documentation and include the counterpart of the transaction. And this is aligned with a lot of the changes in law, not related specifically for transfer pricing, but they are trying to see, the authority is trying to see the whole picture in a transaction. So we see in restructures that they are asking not just the shareholders, but which one are the indirect shareholders. So here is the same. They want to know who is receiving the payment, and if these entities in the conditions of actually provide the service that they say, or the product that they are selling, or whatever is the payment or the reason of the payment. Other changes regarding are more, you have to explain with more clarity the comparability elements that are also in the law in another article. And finally, if you have already transactions with foreign related parties in Mexico, you know that you have to present your Appendix 9. This is Section 10 in Article 76. And this Appendix 9, now you have to include your domestic transactions. And also, it seems that it's going to be, you have to fulfill this Appendix 9 until May 15. Another change in Article 76 is to include Section 20 that refers to inform to the tax authorities the purchase and sales of shares that represents our property of goods emitted by Mexican taxpayers, but carried out by residents in foreign countries without a permanent establishment in Mexico. That is a transaction that is made abroad. The information here, well, should be presented within the next month of that this is happening. And otherwise, it is important to mention that if the company does not present this information, is considered as solidarily responsible, is also responsible for the calculation and payment of the corresponding tax to the Mexican resident. And therefore they are going to be obligated to pay. The Mexican entities are going to be obligated to pay. And here also we have some changes in Article 76/A, which refers specifically to local file, master file, country by country report. In the US, probably there is no obligation on this, but I believe you all for sure have heard all these transfer pricing documentations. Here in Mexico, the the ones obligated in the past were those that were also obligated to something that we call we know in Mexico as the CIF, or the tax situation statutory of the taxpayer. Practically the same ones that were obligated to this tax statutory information were the ones that have to present the local master file control. Now the change is that the article for the CIF was also changed, so this is aligning the documentation. Now is going to be obligated also when my colleague talk about federal tax code. We're going to see changes in Article 32H and 32A, where taxpayers are going to be obligated to present dictamen fiscal statutory tax report. And what this says that all the companies that are obligated to present this statutory tax return also are going to be obligated to present local master file and country by country report only if the shareholders are obligated to present it. So what this means, and also another important change, is in this Article 32H, this new obligation or taxpayer obligated are the ones that are related parties to an entity that is obligated to have a statutory tax report. So this is going to increase the base of taxpayers that have to present the local file and the master file, because if you are a related party of an entity that presents the dictamen fiscal, well, you are also obligated to present to tax authorities your transfer pricing report or your local file. And another change is that local file is going to be aligned with Appendix 9. It's going to have to be submitted on May 15. In the past, it was submitted in December of next year. So thank you. I'm going to intervene later with another transfer pricing aspects. Leo. Thank you.
Thank you, Maria, for that kind explanation about the most relevant topics related to transfer pricing for corporations. So moving on with one of the final topics that we have in terms of modifications in the income tax law for corporations, we have a clarification on how we need to determine the net profit account, which in Mexico it's abbreviated as QFIN. The modification just comes to clarify the way the net profit account or the QFI should be calculated. It seems that there was kind of like a discrepancy between the current disposition and the intention of the legislator that wrote the article back then since 2004. So the modification or the proposal that they're changing, it's just clarification about the methodology that we need to follow from now on to determine the net profit account. So from now, I will leave the floor to my colleague Arnoldo Rodriguez with the changes related to individuals and multinational companies in terms of the income tax law and the changes in the value-added tax law.
Thank you, Leo, for that kind introduction. And well, basically what we want to talk about then is something that we have seen with the comments of Victor and Leo. Well, there has been some modifications that are being proposed as of this moment in order to introduce a new tax regime for individuals and also for companies or legal companies, right? So the first modification is the exclusion or the removal of the agapes. Basically, the agapes are the agricultural companies or the primary activities or legal entities that carry these activities, and will be transferred to the simplified trust regime. That's why they are being removed. And the second modification on the individual taxpayers is the elimination of some concepts that are equivalent to salaries. Basically, the tax authority is saying that there are some individuals that are taking some advantage of being as a independent render of service, but they are exceeding some very high income on their annual tax return. So the comment of the tax authorities is that they should be moved to another regime, which is the professional activities regime. That regime basically contemplates a little bit more formalities, informative returns and tax obligations that they need to comply. And also, as we have seen in the last years, well, the tax authority has made a lot of advance regarding electronic technologies. Basically, if you may remember, in Mexico around 2010, 2012 was introduced what we call the CFDI, or the electronic signature, or the electronic invoice, sorry. So basically the intention of this introduction is to have a little bit more control over the taxpayers in order to oversee the operations that they are carrying. Well, the employers have the obligation to issue the payroll notes to the employees, in which they detail all the information. And the tax authority, as of this moment, is proposing to eliminate an informative return that contemplates the information that it is being contemplated as of this moment in the CFDI. This to eliminate a little bit of administrative burden that the employer has. And the second is the one that the electronic accounting and informative returns may not be an obligation moving forward, as the simplified trust regime is considering to eliminate the administrative burden that individuals are having as of this moment. We also have, as we have been mentioning through the whole webinar, well, the simplified trust regime. What happens? Well, for individuals, we have what we call the incorporation regime. Well, that regime is being proposed to be eliminated, and it will be replaced by the simplified trust regime. What is the simplified trust regime? Well, basically is another regime, a new regime for individuals that will make a lot easier and faster the administrative burden that they need to comply in order to comply with the tax legislation. This considers that in order to be applicable or to be able to apply the simplified trust regime, all the income that such individuals must have must not exceed 3.5 million pesos during the fiscal year. And there are some rates that are taken in consideration, that it can go from 1% rate of income tax if the income during the fiscal year does not exceed 300,000 pesos, and it can go up to the maximum rate, which is 2.5%, that has a range of income between 2.5 million pesos and through 3.5 million pesos. To the next slide. Well, basically, this regime contemplates the activities that the regime that we have in force as of this moment, and the activities that they are trying to do. The intention of introducing this regime is to make a lot more attractive to individuals to formalize their activity and obtaining their tax ID, paying taxes, so the tax authorities may have more control on the activities and income that has been obtained through individuals that are not subject to taxes, right? And we have, moving on, leaving the individuals' comments regarding the modification or proposals that are being made to the income tax. Well, we have some modifications that are being made to the residents abroad that have income from Mexican source. The first one is the ones that are from acquisition of real estate. Basically, the tax authority have been detecting that the valuations that the taxpayers have been making, well, they have a difference between what they determine and what the tax authority determines. So the tax authority states that if this valuation has a 10% difference, they will go after the taxpayers. But what happens is that the seller, or the one entitled to pay the tax, well, is a foreign resident. But at the end of the day, the income tax law states that this obligation must be filed by someone in Mexico, a Mexican resident, or someone with a permanent establishment in Mexico. So that will submit the contribution. So the tax authority is giving some faculty to them in order to go after the one that filed that contribution, in order to make easier that that lookout for the contribution that was submitted for this kind of operations. Another modification that we can see in the next slide is very related of the comments that Leonardo shared before regarding the alienation of shares. Basically, this is in order to adapt this article in which they are making the reform or the proposals that these sales of shares must contain a business reasons, and these operations must be audited or reviewed by a certified accountant in order to confirm that the operation complies with the tax authority requirements in order to proceed. We have also, regarding the interest payments, the tax authority in the last years has been making a lot of improvements regarding transfer pricing. So what the actual intention of the tax authority is to try to make every related party operation that are comparable to a market value operation. So they are going through making some modifications in the specific article of interest payments in order to confirm that such operations are within transfer pricing rules. And also we have very important topics here that we have. The first one is that for these kind of payments that are being made, or operations that are being made by residents abroad, they usually have the option to design a legal representative here in Mexico in order to carry out the filings of these operations. But such designation of such legal representative or persons, well, basically they do not have the legal capacity, well, or the economic capacity to respond the tax authorities in case of a review. So basically, the tax authority is trying to modify this article in order to make an obligation that the legal representative that is designed for these matters, well, has the economic capacity to respond in case that the tax authority found an omission of on the contribution. And in Article 176, we have the preferential tax regimes, which there is an intention of a modification just to clarify that this regime is not looking after the operations regarding annual inflation adjustment and exchange gains in order to consider them as an income, and of course not consider it as in the procedure of the tax result. Perfect. So my colleague Maria Jose can talk about another topics that have been proposed to be modified regarding transfer pricing.
Thank you, Arnoldo. There are also some changes in Article 179 and 180 that are related to transfer pricing. These articles have all the definitions, conclusion methodologies that we have to use in our transfer pricing documentation. The specific changes involve some specifications and technicalities in the analysis to use the financial information of comparable companies only of 1 year, that is the year under analysis. In the practice, the common practice was to use an average of 3 years for comparable companies. So this has to be changed. And also important, it is incorporated within the law. In the past was in a ruling of the Mexican income tax law, now it's in the law, to use the interquartile range. So, but basically, this is the main changes in these articles. Regarding maquiladora regime, I think this is one of the main changes, and that may affect a lot of our clients. Currently, maquiladora companies can present a safe harbor to calculate their profit for income tax purposes, or they can ask for an anticipated price agreement, an APA. So in Mexico, the APA became really a common practice for the industries. Even methodologies were accepted by IRS and Mexican tax authorities. They were agreed in these methodologies. But now authority, it seems that claims not to have the capacity to review the amount of APS that they receive, that they do not accomplish necessarily what they expected with this program. So the APA, it seems, going to be erased from the article. It's not going to be longer an option for a maquiladora to avoid the permanent establishment. It is important to mention this safe harbor, this APA, was with the purpose of avoid permanent establishment. Now the only option that you will have as a taxpayer is going to be your safe harbor. And changes in that is that you don't have to present any additional format like now is happening. Within your annual tax declaration of maquiladora regime, you will have to indicate if you opted by 4D6.9 on cost and expenses, on assets, 6.5 on cost and expenses, indicated there. And with that, you will have, or the authority will have like fulfill this obligation. So thank you, Arnoldo. I will leave you.
Perfect. Thank you very much, Maria Jose, for sharing those modifications that impacts drastically the income tax law. And just to finish, the modification or the proposals that are intended for the income tax law, well, as mentioned before, the simplified trust regime, it is intended to be introduced for individuals, but also for legal companies. So also they have a very specific rules of how they must apply and what they need to comply. So basically, the intention is also to reduce the administrative burden that the companies has, and the intention is also to invite to formality the ones that are carrying operations that are not subject to tax, right? So they have, for example, a requirement of not exceeding 35 million pesos. So it is intended for smaller companies. They try to go for 30% income tax, and they have a limit on the investments that they need to use. So it is intended just to reach these taxpayers that are small businesses, but they are intended to introduce them to formality. So if we move on to the next topic, we have the value-added tax modifications or proposals of the modifications that are trying to be introduced. If we go to the next slide, well, the value-added tax basically is the one less impacted or try to be reformed, but basically, well, it has some very key importance proposals that are intended to be modified. We may know that there's some rates, VAT rates, in which we have the 0% rate, and it is being introduced or reformed this article that contains the activities for that 0% rate, that the animal consumption, food or feed, will be considered a 0% rate. Previously, it was unclear if this was 16% rate or 0% rate. So this will clarify and give certainty to the taxpayers that carries these operations. Through time, this article or this specific topic regarding food and animal consumption has been modified. So this is a great improvement for this article. And as of this moment, there's a legal precedent, or there's a rule in the legal disposition, tax dispositions, that explains a little bit more about this, but it is proposed to be introduced to the law in order to give certainty to these operations. And the second modifications to this article regarding the 0% rate is that the menstrual products that the female gender requires, well, basically they will also be taxed at 0%, which as of this moment is taxed at 16%, and well, it has an economic impact on the budget, right? Also, the intention of one of the modifications that is being proposed to the VAT law is to introduce a new article 4A. Basically, what this article will try to do is to give a little bit more certainty of the operations that are not subject to the VAT. I'm not talking about 0% rate, 16% rate. These are the operations that are being carried by someone in Mexico, but by some instance is not subject to 0% to any rate as of this moment. And there are some complementary modifications that are being made through the law in order to comply with these modifications. The impact that this will have is that there's a crediting factor regarding the VAT that the taxpayers must do. Well, those operations that are being detailed on this article will impact this determination. If we go to the next slide, also we have two other topics that I consider very important. The first one is that all the import documents or what we call here in Mexico or Spanish are the pedimentos, which are the documents that the taxpayers must have in order to import the goods, right? So what the tax authority has detected as of this moment is that those documents are being issued to another taxpayer, but a third party is crediting that VAT. So one of these modifications is that this document must have that name or tax ID of the person that will be crediting that VAT, as we have, for example, in normal invoices. The normal invoices, in order to make deductible and made that VAT creditable, must consider the legal name of the company or the individual, and obviously the tax ID. Well, this is an example of how will this compare to the pedimentos. As pedimentos, in order to be creditable, the VAT to be creditable, well, it must have the taxpayer information in order to be creditable. And the second one is that the taxpayers that are in preparative periods and are going further and will start operations, well, they need to notice the tax authorities that they will go into operations. In order for the tax authorities have the knowledge of this, and the intention of the tax authorities on this is that they will know when the taxpayers will calculate that that proportion of VAT creditable that I talked in the previous slide, in case that this is creditable. Moving on to the next topics. Well, as mentioned before, in the VAT law, we have a specific article that specifies the rules or procedure or determination for VAT regarding incorporation regime. Well, this article will be disappearing if that regime also disappears, and there will be transitory articles that will try to give a little bit more certainty of what will happen once this regime is eliminated. Also, one of the main modifications that was made for fiscal year 2020, I'm sorry, was the provisions for digital service in Mexico. There's an obligation in the VAT law that was introduced in order to file an informative return regarding the digital services that were provided. But this information was submitted quarterly, so the tax authority is trying to modify that obligation to be on monthly basis. And the reason why is that they want to compare the VAT payment and this informative return on monthly basis. As we may remember, the VAT is submitted on monthly basis, so this will help the tax authorities in order to review the operations that these companies are having. And what happened? There's an blocking to the web that the tax authorities may issue to these kind of taxpayers, and this provision is not being modified to the monthly basis. As of this moment, this block to the web is considering 3 months block to access the web. So this may be modified during the legal process of the proposal of the VAT law. And one of the last topics that the tax authority is proposing is just to define or give a little bit more certainty to some operations that some taxpayers carries regarding the enjoyment or use of tangible assets. As of this moment, the law states that if the assets is being delivered to within the Mexican territory, will be subject to tax. So some taxpayers will deliver that good somewhere else that is not Mexican territory in order to avoid that VAT. So the tax authority is going a little bit further and is trying to restrain this by introducing that regardless the place of delivery or celebration of the or of the legal act, if that asset at the end of the day will be used in Mexican territory, will be subject to VAT. My colleague Renata will follow with the presentation in order to share some comments on this proposal.
Thank you, Arnaldo. Hello, good morning, everyone. Thank you very much for joining us. We have arrived to the last part of the webinar, so please stay with us. There are about 100 proposed changes to the federal tax code. I will only mention the most relevant ones for the sake of time. Tax residents. It is proposed that tax residents in Mexico, whether entities or individuals, will maintain their status unless they can provide and demonstrate a change of residence. If the residence is moved to a low tax jurisdiction, the resident status in Mexico will be maintained for a period of 5 years, rather than the 3 years currently stated. This is to be consistent with the period that the tax authorities have to exercise their powers of verification. When the residence is moved to a low tax jurisdiction, it is proposed that the term of 5 years will not apply when a said territory has a comprehensive information exchange agreement in force with Mexico, and also there is a treaty in force that allows the mutual administrative assistance in the notifications and collection of contributions. Regarding corporate mergers and spin-offs, it is proposed to apply the rules and tax consequences corresponding to the sale of assets when in the exercise of verification powers, the tax authorities detect that such operations lack business reason. For these purposes, the relevant operations carried out 5 years before and after that relate to the merger or spin-off will be taken into consideration to determine if there was a valid business reason. The merger and spin-off financial statements must be audited by a CPA. And finally, it is proposed to clarify that in the case of a spin-off, a share capital must be transferred, meaning that the shareholders of the spin-off company must maintain the same proportion in the share capital that they had prior to the spin-off. Otherwise, the transaction will be deemed to be a sale of assets. Electronic signature. The authorization to obtain the electronic signature or a digital certificate will be denied when the tax authorities detect that the legal entity requesting the electronic signature has a partner or shareholder who is in an irregular tax situation and has not corrected it, or having a regular situation, the partner or shareholder has participation in other blacklisted companies. New assumptions for the restriction of digital certificates. Without digital certificates, it is not possible to issue electronic invoices, perform foreign transactions, or complete certain procedures through a tax authority's website. In other words, without digital certificates, the company will face serious limitations to operate. It is worth mentioning that the tax authorities have found here a very useful tool to encourage taxpayers to satisfy their tax obligations, and now new assumptions for the restriction of digital certificates are proposed. First, for taxpayers showing differences between income and withholdings declared in monthly tax returns versus invoices and also informative returns. In this case, the tax authorities will identify such differences by using not only the information filed by the taxpayers and third parties, but also by using any other database to which they have access to. Second, also this restriction would be for taxpayers that have not started operations with blacklisted companies. Third, for companies with shareholders with irregular tax situations. Four, for non-cooperative taxpayers under an audit scenario. And finally, for taxpayers that contribute under the simplified trust regime that omit filing 3 monthly consecutive or not returns, as well as the annual tax return. We have new regulations for tax ID. So Mexican citizens above 18 must obtain a tax ID. It is also proposed that the tax ID of taxpayers with no activities in the previous 5 years will be canceled. And also the tax authorities have clarified that the name and tax ID of new shareholders or partners must be informed when the shareholding modifications involve thus with effective control over society. And also for liquidation processes will be mandatory to have a positive opinion of compliance with Social Security contributions. The tax invoice is undergoing many changes, but I am not going into detail since that's more an operational task that your team in Mexico will handle. However, it is important for you to know that the tax authorities are looking forward to update the economic activity and the obligations of the company based on the description of the invoices. Therefore, the economic activity of the company and the concept included in the invoice must make sense. Regarding the relevant transactions, we have new hallmarks to disclose in the relevant transactions informative return, such as exempt mergers and spin-offs, sales of shares at fiscal cost in the case of corporate reorganization of Mexican groups, and sales of shares issued by Mexican companies but owned by foreign residents. Statutory report for tax purposes and tax situation informative return. The statutory report becomes mandatory again for taxpayers deriving income greater or equal to 44 million USD approx, as well as for stock market companies that have shares available to the investing public. The statutory report will remain as an option for some companies, and related parties of companies required to file the statutory report for tax purposes must now file the tax situation informative return. It is proposed to make the CPA responsible of covering up non-compliant taxpayers when they fail to inform the tax authorities about situations that may qualify as a major crime, such as the tax fraud. And now I will give the floor to Maria Jose to please, Majo.
Sure, thank you, Renata. Also, in federal tax code, we have changes regarding transfer pricing. I would love to talk about the faculty now of the authorities under the exercise of its powers of audits to determine the simulation of acts with related parties separation for tax purposes. So here the authorities, they can now establish that there was a simulation and act, but they have to prove that or give their explanation. So it is necessary for them to identify the simulated act versus the reality, to quantify the tax benefit that was obtained and indicate the elements that they use to determine the existence of the situation of this economic and simulated act. And this has to include the intention of the parties to simulate the act. Other aspects, as secret comparables can be is now show in the federal tax code. That is that authorities can disclose after emitting the observation letter in an audit process this secret comparable, so this inside information of the market or other taxpayer that can affect or change the perspective or the audit process of transfer pricing. So the rules here, there are strict confidentiality for the parts involved in this. Before it was possible only with domiciliary visits. Now it is also possible with remote reviews. But this is one also major change that we don't know how it's gonna affect this audit process. Thank you, Renata. I will leave you.
Thank you, Majo. Now, qualified tax fraud. Two new scenarios of qualified tax fraud are proposed. First, to fake the rendering of independent professional services to avoid the new labor reform regulations. And second, to obtain a tax benefit by any means that could violate our current anti-corruption legislation, whatever that means. Second, next slide, please. Self-correction by applying balances in favor. The option is incorporated to the taxpayers who are subject to the exercise of verification powers can correct their tax situation by compensating the amounts that they are entitled to receive from the tax authority against the taxes they owe, even if those amounts comes from different contributions. Joint liability. New scenarios of joint liability are proposed. First, in the case of acquirers of commercial negotiations. Second, for legal representatives of non-residents in Mexico up to the amount of their corresponding contributions. And third, for legal entities that have not submitted information regarding the transfer of shares between residents abroad. Those who accept voluntarily to be jointly liable must undertake the responsibility through the means to be published by the tax authorities. Verification powers. The proposal puts forward new tax audit procedures, including the review of financial institutions, trustees, beneficiaries of Mexican trust, and the members of any legal vehicle. Conclusive agreement. The conclusive agreement is a legal figure who raises an answer to the many complaints of taxpayers being audited. In this framework, the Procuraduría de la Defensa del Contribuyente, PRODECON, for its acronym in Spanish, designed a special procedure in order to offer better and definitive solutions to every audited taxpayer. So the PRODECON acts as an intermediary between the taxpayers and the tax authorities, and even acts as a public witness in certain procedures. So the taxpayer ombudsman advocates for convenient resolutions not only for taxpayers but also for the tax authorities, because the objective is to build progressively a new relationship between the parties. However, this procedure is too long, which is why the tax authorities propose to limit the negotiation to a period maximum of 12 months. Reduction of fines. In general terms, the concept fine forgiveness is replaced by fine reduction, basically because our current administration has banned the tax forgiveness. And well, we have arrived to the end of our webinar, and we will continue with our Q&A session.
Thanks, Renata, and thanks, Maria Jose, Arnoldo, and Leo. I think these last 2 hours has been very productive. Definitely, there are a lot of interesting things in these proposals we need to attend. And I have received so many questions, and most of them quite interesting. So I will start with one. Probably this should be handled by Leonardo. This is regarding the filing of notice for disposing of assets. So the question is, when will I need to file this notice so I can take the deduction in my tax return?
Thank you very much, Victor, for the question. Frankly speaking, so far the law doesn't mention or specify the time frame nor the form that will be needed or that will be requested to be able to file this notice. From my point of view, I think it's fair to say that the notice should be filed within the same fiscal year where you plan to take the deduction. So just for putting an example, this might take place in 2022. So if you plan to take this deduction in that year, you would have, my guess would be that you would have up until December 31st, 2022 to make the filing of it. So you can take the deduction in the tax return, even though you're going to file it up to March 31st of 2023.
I agree, Leo. Thanks for that. I have another question. This is regarding the APA, probably Maria Jose, you're the expert on this. So the question is there going to be another mechanism that replaces the APA?
Well, the issue here is that no. There are certain certain people that is saying not replacing the APA, but that you probably can file your APA today, so they can come to 2024 and pray for in 2024 there is another mechanism that may save you. But the reality is now the authorities are trying to be really clear on this, because they explain that they do not have the capacity to review all this. It's becoming a little more complicated for them, expensive. So the main idea is no. You have to comply with the safe harbor to comply with to not be a permanent establishment if you are a maquila. And this is only for maquilas. This is important. Yeah. You can always go for an APA for other transactions with tax authorities. This is specifically for maquilas.
Yeah. Thanks for the clarification, Majo. So basically, these new rules applies only for those foreign entities that operate in Mexico under a maquila scheme. So as Maria Jose mentioned, there were two options: going for an APA or calculate your taxable income under the safe harbor. So now, if this proposal is accepted, which we expect to be, the only option for maquiladores will be to stake on the safe harbor calculation. We invite everybody to continue sending your question. Actually, if we don't have time to answer them, we can contact you after we are done with the webinar. I have another question. Just give me a second. Wow, I think this is a really interesting one, and actually is one I have received a lot from my clients. The question is, what is considered to be a valid business reason? And Renata, this is the question of a million. Your turn.
Thank you. So the business reason concept was adopted for the first time in the Mexican tax legislation in 2020. Since then, it has become like a popular tool used by the tax authorities to challenge transactions carried out by taxpayers, and it has a strong presence in the 2022 tax reform proposal. We have two elements to determine a valid business reason. First, the existence of a tax benefit. And what should be understood as a tax benefit? Well, any reduction, elimination, temporary deferral of a contribution. It includes deduction, exceptions, non-collection of taxes, non-inclusion of income, adjustment to the tax base, the use of tax credits, a change of tax regime, among others. And the second element is that the economic benefit must be higher than the tax benefit. The economic benefit also has certain features, such as the creation of revenue, the reduction of cost, the increase of value of the assets, and improving the market position, amongst others. So the economic benefit also, the tax authority said that it must be supported by contemporary documentation, and it must be reasonable. So for just as a summary, what would be a valid business reason? That where the tax benefit is not higher than the economic benefit, no, meaning that the transaction has not only a purpose to avoid or decrease taxes, but it's actually looking for this economic this economic purpose of the company.
Thanks, Renata. Yeah, and I agree with you that the main purpose of all the transactions to be performed within the companies should be seeking the economic benefit. And actually, for our audience, all the major reforms that have been incorporated in law for the recent years intends basically to avoid any tax fraud or to fight any tax avoidance through this type of rules. So, well, I think we have reached the end of our webinar. It has been a pleasure talking with our friends, clients, and my colleagues. You have our data information here. As I mentioned, I have received many questions, so we will contact you after we finish our webinar. Thanks all for attending. Please keep safe.